Hi, I'm Lisa Dorian, Managing Director, CRO, and co-founder of CFI. Welcome to our course on financial analysis for credit. There are many factors that go into making an effective credit decision, including assessments of industry, business, and management. But perhaps the most important assessment is related to financial information. Being able to analyze and interpret a set of financial statements is critical to effectively assessing the others, as this analysis will inform many of the questions you'll ask surrounding the other topic areas. By the end of this course, you'll be able to understand the components that go into financial analysis, calculate the key performance ratios that credit professionals use to assess a company's profitability and efficiency, calculate the key financial ratios that credit professionals use to assess a company's liquidity, leverage, and coverage. Undertake a vertical analysis to determine profitability from the income statement and proportionality from the balance sheet. Undertake a horizontal analysis to spot trends and analyze their meaning. Perform industry benchmarking, and use all this plus much more to help guide your assessment of an organization, its competitive advantage, and its management team. Throughout this course, you'll be watching video lectures, participating in interactive exercises, and applying your knowledge through the use of various templates. At the end of the course, you'll take a qualified assessment to test what you've learned. This course is core to CFI's Commercial Banking and Credit Analyst Certification Program. We've got a lot of great material to cover, so let's get started.
Financial analysis includes a number of different steps in order to get a complete picture regarding the performance of a company. The starting point for this exercise is the company's financial statements, in particular, its income statement, its balance sheet, and its statement of cash flows. We often focus on the income statement and balance sheet for calculating ratios, but we also use the statement of cash flows as the source of input data for ratios. For example, depreciation and amortization expense, or dividends and other corporate distributions, such as the repayment of shareholder loans. Ratio analysis is actually a good way to understand the relationship between the income statement and the balance sheet. It's very important to understand that financial analysis must be undertaken with an end purpose in mind. Your end purpose will influence how you conduct your analysis, as well as how you interpret the results. It could be to estimate the intrinsic value of a company's publicly traded shares. Perhaps it's to assess the value of a firm for the purpose of M&A negotiations. For a credit analyst or a commercial banking professional, though, the analysis is conducted with the end goal of understanding a company's overall financial health and a borrower's credit risk, the ability to service credit obligations into the future, and to understand how they might mitigate a loan loss in the event of a default scenario. With a set of financial statements, you'll be able to perform a trend and ratio analysis to accompany the cash flow analysis that you'll need to perform. Note that we cover cash flow analysis in detail in our Cash Flow Cycles and Analysis course as part of the CBCA certification program. The focus of this course is on trend and ratio analysis. We'll cover the basic ratios important for making a credit decision. We'll discuss the different types of adjustments we may do in order to normalize the ratios by adjusting for distortion, and also where there may be more complex adjustments required. For example, financial analysis is frequently conducted within the context of a specific borrowing request. In order to assess the viability of that borrowing request, lenders must overlay the proposed credit facilities, things like operating lines, term loans, commercial mortgages, and so on, as well as their terms, like rate and amortization, on top of financial results in order to see how important financial metrics are impacted by adding this debt to the balance sheet. A credit professional may conduct the analysis using actual current and/or historical results, as well as using projected operating results too. So, how is ratio analysis done? Well, once we have a set of financial statements, we can perform different types of analysis, often in two forms, vertically and horizontally. Vertical analysis is done from a proportional point of view. Essentially, it compares line items in a single financial statement to a base figure. It's called vertical analysis because it's conducted from top to bottom of the financial statements, specifically using the income statement, the balance sheet, and the statement of cash flows, but all separately. For example, using the income statement, we can take components under revenue and divide by revenue in order to express it as a percentage to get a sense of how profitable the company is. We can analyze the balance sheet by looking at individual components and dividing those by either assets or liabilities, depending on which side of the balance sheet you're using. For example, what percent of total assets are current versus fixed? Vertical analysis is an important exercise for a credit professional to do, as it does help to evaluate the prospective borrower. But measured against what? You may wish to compare this client or prospective borrower to other companies in your credit portfolio in the same industry or sector to understand their relative position. You may also wish to use an industry benchmark sourced using a third-party data provider, again, to compare the company against their peer group. Alternatively, depending on the models available at your financial institution, the vertical analysis measures may be scored against internal thresholds, which flow through to a proprietary risk rating. In all cases, vertical analysis is conducted for the purpose of comparison. For example, the ratios can also be compared to industry performance to assess how the company has done for the year against its peer group. In fact, before you even get started on calculating the ratios and performing your analysis, you can set some expectations and see if the ratios play out the way you expected. For example, is the calculated gross margin of the company consistent with industry averages? Or if the company is a manufacturer, consider what your expectation would be for fixed assets, or PP&E, as a percentage of total assets versus that of a retailer. Where outside of industry averages, the analysis will help you ask questions of your client or prospective borrower to determine why the difference exists and, if lower than industry average, what they're doing to improve their performance. Horizontal analysis is where the majority of analysis is done, by providing context both within the company performance itself, as well as through further comparisons with its peer group in the industry. Horizontal analysis looks at trends in headline figures in the financial statements over time. It benchmarks trends internally across years, and it benchmarks a company externally against its industry peers for that same time horizon. Vertical analysis paired with horizontal analysis provides far more useful information, as you can look at the trends versus one point in time. However, horizontal analysis also allows for consideration of other financial trends and the calculation of other ratios, such as those for liquidity, solvency, and leverage, using cross-financial statement numbers to be used to perform the time horizon comparatives. Consider this. Let's say that the company has had positive revenue growth of 5% year on year. That would be an indication that the company is doing well. But what if industry revenue growth was trending at 15% year on year? This would have you asking different questions of companies' management to determine why they aren't keeping pace and whether there may be a future threat to sustainability that needs to be considered. Questions would surround a better understanding of the company's competition and its competitive advantage, as well as its strategy to improve its competitive advantage and what threats management has identified and are mitigating to sustain or improve the company's market position. Remember that analyzing credit means identifying any risk to repayment capacity. Not keeping pace with industry trends can be indicative of a company in decline and also could be an indication that the risk of not being repaid is higher. When performing ratio analysis, there are two basic groups of ratios that we calculate and analyze: performance and financial. Performance ratios speak to how a company is doing, how profitable it is, and how efficiently it's being run. Financial ratios speak to the financial condition of the company, how liquid it is, how solvent it is, and how effectively operating cash flow covers principal and interest obligations, both currently and including any proposed new debt. We'll cover each group of ratios in turn throughout this course, starting with performance ratios and specifically profitability ratios. To calculate these ratios, we work with the income statement. Before we get into profitability ratio calculations, let's spend some time reviewing the components of an income statement. This should serve as a review for you, as you would have already learned this in the Reading Business Financial Information course that's part of the CBCA core curriculum. If you look at this example, you'll notice that each of the components on the income statement have been color-coded. This helps show how line items are grouped and categorized on the income statement. Starting at the top, we see sales or revenue. Revenue is the lifeblood of the company and a major component of ratio analysis. In order to generate revenue, the company is going to incur direct costs, known as cost of goods sold for companies selling products or cost of sales for service-related companies. These costs include anything that is directly related to the sale of the product or service. This includes raw materials for manufactured products, direct labor relevant for both products and services, and other costs related to generating the revenue. It may also include the depreciation specific to manufacturing equipment, for example, in generating the goods that are being sold. After deducting cost of goods sold or cost of sales from revenue, we arrive at our first major subtotal on the income statement, gross profit. Gross profit is what remains to fund the rest of the business's indirect costs after paying those costs directly related to what was sold. Let's look next at those indirect costs. These expenses are those that are required to run the business and are very important for generating growth, but that are not directly related to the cost of revenue, and hence they're shown below the gross profit line. Common examples include research and development, sales and marketing, as well as general and administrative expenses required to operate the business. Let's look into these generalized categories in a little more detail. Research and development represents costs that are required to keep up with or stay ahead of the competition. They include costs related to getting a new product to market, such as spending time developing a new software application. Marketing and sales represent the costs that are required to get the products or services out to customers and include items like advertising. And finally, general and administration, sometimes referred to as G&A, are those costs that can't be allocated anywhere else and usually include things like legal and accounting costs, salaries for people in accounting, human resources, and IT, travel and rent expenses, information technology, and other general office expenses. In manufacturing or construction, they can also include things like the salaries of foremen or supervisors, and small tools and other costs relative to estimating and bidding for jobs. Depreciation and amortization, as mentioned earlier, that's not directly related to cost of sales, would appear in this group of indirect expenses. These would include physical assets such as furniture and fixtures, leasehold improvements, and computer equipment and intangible assets such as trademarks. After deducting these indirect expenses, we arrive at the next major subtotal, which is operating income, also referred to as operating profit or EBIT, or earnings before interest and taxes. Operating profit is what remains to pay governments, creditors, and shareholders. Below operating profit, the interest line represents both interest income that's earned and interest expense that's paid. A company may be a generator of interest income if it invests excess cash in fixed income products that pay interest, like a term deposit, for example. Unless the company is within the financial services industry, interest income falls below operating profit and is not included in revenue because it's not part of the general operation of the business. Interest expense is incurred when a company takes on debt to finance its operations, to finance working capital, or to purchase a building or equipment, for example. After interest has been deducted, there may be another subtotal, which is earnings before tax. After earnings before tax, the last item to be deducted is taxes, which includes both current and future income taxes. And finally, we arrive at the bottom line to the income statement, net income or net profit. This represents what's left to be paid to shareholders as dividends, or if not paid, then retained and reinvested in the business. While it's possible to calculate the ratio for every single line item on the income statement, for the credit professional, the focus is on the most important profitability ratios. And the most important ones are those relevant to margin, the gross profit, operating profit, EBITDA, and net profit margins. Let's first start with gross profit margin. Gross profit margin can be calculated by taking the gross profit and dividing it by revenue. To get gross profit, we take the revenue and subtract cost of goods sold or cost of sales. This ratio tells us, for every dollar of revenue that was generated, how much is left over after paying the cost of sales or the cost of goods sold. This leftover amount is what's used to pay for all of the other costs related to running the company. The higher this number is, the better. The second profitability ratio we'll look at is directly related to the earnings before interest and taxes of the business, which normalizes for different tax rates as well as for capital structure decisions, like higher or lower amounts of debt as a funding source. It's known as the operating profit margin. In order to calculate the operating profit margin, we take the earnings before interest and taxes, also referred to as EBIT or operating profit, and divide it by sales revenue to return a percentage. The higher this percentage is, the more profitable the business is. As you'll recall from earlier, the operating profit is what's left to pay interest to lenders, taxes to governments, and dividends or other forms of return of capital to shareholders. EBIT is a common metric in valuation work, and it serves as an important part of the equation to calculate free cash flow to equity when conducting a discounted cash flow analysis. While a useful metric for many purposes, EBIT may be less of a focus for many credit professionals because it fails to capture some important non-cash items, which leads us to our third profitability metric, the EBITDA margin.
Continue learning. Join CFI today.